Hello, friends. Welcome to Budget IQ. We have got to talk about a huge financial deadline that is sneaking up on all of us. I'm going to walk you through 5 very specific, very powerful moves you should seriously think about making before that ball drops on New Year's Eve. Let's get right into it. Okay, I want you to imagine something. Picture your favorite store, maybe a high-end electronics shop or designer boutique. You walk in, and there's a giant sign, "Going out of business sale." But here's the catch. The sign also says, on January 1st, new management takes over and all prices are going up by 30%. What would you do? You'd buy everything you could right now, right? Well, believe it or not, that is pretty much exactly what's happening with the U.S. tax code.
Right now, we are living in the TCJA discount era. But on January 1st, 2026, those tax prices are set to go way up. This is what everyone is calling the 2026 cliff. The big tax law we've had since 2018, the Tax Cuts and Jobs Act, is just expiring. It's going away. And unless Congress steps in, and let's be honest, who knows if they will, our tax brackets, our deductions, they're all snapping back to the old, much less friendly levels. This is your last chance to shop the sale.
And look at this. This is where it gets real. For so many of us in the middle income ranges, those brackets are jumping from 12, 22, and 24% up to 15, 25, and even 28%. That's a huge deal. So the whole game plan, the number one strategy we need to focus on before December 31st is this. Take your income now while taxes are on sale and try to push your deductions into the future when they'll be worth more because the rates are higher. It's all about timing.
All right, let's get into our first move. Move number 1 is all about supercharging your 401k. And listen up, because this is a total game changer, but it's for a very specific group of people, those aged 60 to 63. This comes to us courtesy of the Secure 2.0 Act.
$11,250. Get that number in your head. What is it? Well, there's this brand new rule, and if you're going to be 60, 61, 62, or 63 years old in 2025, you unlock something called a super catch-up contribution. This is a whole new level of saving.
So let's put this in perspective. You know how people age 50 and over can make a catch-up contribution? That's a solid $7,500. But for this special 60 to 63 age group in 2025, it skyrockets to $11,250. That is a 50% increase. We're talking about being able to stuff almost $35,000 into your 401k for the year. That is an incredible opportunity.
Okay, but wait, there's a really critical warning here, especially if you're a high earner. We're talking about anyone making over $145,000. There was a rule that was supposed to start, forcing you to make all these catch-up contributions on a Roth basis, paying the tax now. But guess what? The IRS hit the pause button. They delete it. This means 2025 is your absolute last chance to make these huge catch-up contributions on a pre-tax basis, which, lowers your taxable income this year. Okay, on to move number 2. This is a strategy I love to call sunset arbitrage. It sounds fancy, but the concept is simple. We're going to lock in these low rates before they ride off into the sunset. And our main tool for this? The Roth conversion. Look at this chart. It tells a whole story. Let's say you're paying taxes at a 24% rate in 2025. Well, in 2026, that same income could easily be taxed at 28%. So think about it. By doing a Roth conversion this year, you are choosing to pay the taxman 24 cents on the dollar now to avoid having to pay him 28 cents, or maybe even more, later. It's like prepaying for something at a discount. It's a strategic choice. So why is this so important? Well, it's to avoid a nasty little thing called the tax torpedo. Imagine this. You're retired, life is good, and then, bam, you're forced to start taking these huge mandatory withdrawals from your traditional retirement accounts. Not only does that money get taxed, but it can be so much income that it pushes you into a way higher tax bracket and can even cause your Medicare premiums to explode. A Roth conversion now helps you defuse that bomb before it ever goes off. These first 2 moves alone can save you so much money down the line. If you're finding this helpful so far, do me a quick favor and hit that like button and subscribe if you haven't already. It honestly helps the channel so much and tells me you want more content just like this. Okay, let's keep going. All right, let's pivot from retirement accounts to your regular investment portfolio. Move number 3 is all about doing a little portfolio cleaning. The official term is tax loss harvesting, and it's a super smart way to turn some of your market losers into tax winners.
So here's how it works. With regular stocks, there's something called the wash sale rule. It basically says you can't sell a stock at a loss to get the tax break and then just buy it right back the next day. You have to wait 30 days. But, and this is huge, there's a loophole. Right now, the IRS sees cryptocurrency as property, not as security. What does that mean? The wash sale rule doesn't apply. You could, in theory, sell your crypto at a loss on December 30th to capture that tax deduction and then buy it right back on December 31st. It's a massive advantage that might not be around forever. Now, that crypto loophole is a really powerful tool. But of course, I have to say this. Please remember this is all for educational purposes. I'm not your financial advisor, so you should always do your own research and talk to a qualified professional before making any big moves.
All right, moving on to move number 4. This one is for all of you generous people out there who love to give to charity. Here's the problem. Thanks to the super high standard deduction these days, it's become really hard to actually get a tax break for your donations.
Just look at this number. For a married couple in 2025, the standard deduction is nearly $30,000. That's the bar you have to clear with all your itemized deductions, charity, state and local taxes, mortgage interest, before it even makes sense to itemize. So if you give $5,000 or $10,000 to charity, that's amazing, but you're probably not getting a direct tax benefit from it.
So what's the workaround? It's a brilliant strategy called bunching. Here's how it works. Instead of giving, say, $10,000 a year, you bunch 2 or 3 years of giving into one big donation in 2025. You put that lump sum, say 30 grand, into something called a donor-advised fund, or a DAF. Think of it like your own personal charitable savings account. The magic is, you get the full tax deduction for the entire $30,000 this year, which gets you over that standard deduction hurdle. But then you can grant that money out to your favorite charities over the next few years, just like you normally would. It's the best of both worlds. You support your causes, and you get the tax break.
And that brings us to our 5th and final move. And folks, this is the big one. This is the generational wealth play. We're talking about the estate tax, and this is truly a use it or lose it opportunity. Check out this number. Roughly $13.99 million. That is the per-person federal estate tax exemption right now. It is a historically unbelievably high number. That means a married couple can pass on almost $28 million to their heirs completely free of federal estate tax. It is absolutely unprecedented. But here comes the cliff. Take a look. On January 1st, 2026, that massive exemption gets chopped basically in half, dropping all the way down to around $7 million per person. For families with larger estates, that is a $7 million difference per person. That gap represents millions of dollars that could go to the government instead of your family. Now, here is the most important part of this whole strategy. The IRS has officially said there will be no clawback. What does that mean? It means if you used your big exemption now by gifting money to family or putting it in a trust, the IRS can't come back later, after the limit drops, and try to tax that gift. It's grandfathered in. This is why it's use it or lose it. If this is even remotely on your radar, you need to be calling an estate planning attorney like yesterday. Okay, I know that was a ton of information, so let's boil it all down into a simple, actionable playbook. Here is your final checklist for what to do before December 31st. First, check your age. If you're 60 to 63, you have to look into that $11,000 super catch-up. Second, check your tax bracket. Does a Roth conversion make sense to lock in these lower rates? Third, check your portfolio for losses. Use tax loss harvesting, and definitely take a look at that crypto loophole. Fourth, check your charitable giving. Could you benefit from bunching your donations into a donor-advised fund? And finally, fifth, check your estate. If you're in that high net worth category, you have to act now to lock in this historic exemption.
So here's the bottom line. The 2026 tax cliff isn't some maybe what-if scenario. It is written into the law as it stands today. It is coming. So the only question left is, are you going to be ready for it? Thank you so much for watching, friends. I really hope this gave you a clear playbook to work with. If it did, please hit that like button, drop a comment with your biggest takeaway, and subscribe to the channel. It is honestly so motivating and helps me keep making these videos for you. Here's to making smart moves and getting ahead of the curve.